Why is the AED-USD stablecoin conversion rail such a significant milestone for institutional finance?
I think it's more important around this idea of currencies being on chain. The idea that you're able to swap into USD stablecoin that's issued globally, and then get that swapped instantaneously into a dirham-backed stablecoin for local payments is a very interesting model for folks to be able to look at.
Why has direct conversion between two regulated stablecoins been difficult until now?
I think you have around 21 different stablecoins across currency pairs, but generally liquidity and someone that sits in the middle to provide, FX liquidity has been a bit of a struggle. And as more liquidity comes into these alternative fiat pairs, I think you'll start to see, market makers that traditionally act and operate in that space start to shift and provide the infrastructure and liquidity that's necessary to do this on chain.
What are the biggest remaining barriers preventing institutions from fully embracing stablecoin-based settlement rails?
Generally, the biggest barrier has always been around regulation. I think the second piece is
Hi friends of CCM, thank you for joining today's chat with Stephen Richardson, who's Chief Strategy Officer and Head of Banking at Fireblocks. Thank you very much for joining us, Stephen.
Thank you for having me.
So let's start this chat with the Chief Strategy Officer of Fireblocks. Why is the AED-USD stablecoin conversion rail such a significant milestone for institutional finance in the Emirates and all the industry region?
Yeah, look, I think it's more important around this idea of currencies being on chain and the ability to really have on-chain FX, or the ability to really swap those currencies seamlessly between different jurisdictions. There's a lot of business between the Emirates and between the United States. A lot of what's priced in globally is priced in dollars. But as you think about the utilization of stablecoin for payments in the UAE, it does have to be a dirham-backed stable, right? So the idea that you're able to swap into USD stablecoin that's issued globally, and then get that swapped instantaneously into a dirham-backed stablecoin for local payments is a very interesting model for folks to be able to look at. Also, it's an interesting model just from a global commerce perspective, right? So as you think about broader trade finance, as you think about the idea that we're going to see a multi-currency world on chain, this is a pretty interesting model leveraging, bank infrastructure locally to be able to execute on-chain FX.
Why has direct conversion between two regulated stablecoins been difficult until now? And how does this change the way banks and asset managers think about on-chain forex and liquidity management?
Yeah, so I don't necessarily think it's been difficult. I think there's always been a question around liquidity, right? So, you're just starting to see the emergence of euro-based stables. Obviously, Circle's been in Europe. You saw the announcement around Quavalis, the bank-issued stablecoin consortium in Europe. You have some in LATAM. I think you have around 21 different stable coins across currency pairs, right? But generally liquidity and someone that sits in the middle to provide, FX liquidity has been a bit of a struggle, right? So I think, in this case, they're operating with a bank locally within the UAE to help them execute this settlement and settlement rail, right? And inherently that bank provides some level of liquidity and FX against this dollar pair versus dirham pair. I think, this will become a very interesting basis, right? So globally at Fireblocks, we're seeing a lot around stablecoins and the utilization of stablecoins for corporate and transactional banking on a cross-border level, which is leading a lot of banks to really explore, or at least a lot of institutions to explore, whether or not they should be tokenizing fiat assets locally within their jurisdictions for the purposes of cross-border trade and internal trade, right? So I think you're just going to start to see more liquidity come into these alternative pairs. And as more liquidity comes into these alternative fiat pairs, I think you'll start to see, market makers that traditionally act and operate in that space start to shift and provide the infrastructure and liquidity that's necessary to do this on chain.
What makes the Emirates regulatory framework stand out compared to other jurisdictions supporting stablecoin infrastructure? And how important is dual regulatory oversight in boosting the adoption?
Yeah, look, I think, the UAE has provided a basis in which the central bank of the UAE has authorized folks to participate in dirham-backed stablecoins, right? So you're getting it directly or getting direct approval from the central bank to be able to operate a stablecoin within the country. It's unique in that obviously USD stablecoins that are, let's say regulated abroad can't be used for local payments, like fiat payments, right? So it's really around like broader, let's say, corporate transactional type use cases in which US dollar stablecoins can be utilized. So you have like a global pair basis against a local currency basis, which I think is pretty interesting. But look, I do think it's important that, in essence, you have support from a regulator, right? So obviously, in the United States, you have like the Genius Act, which really gives like a basis for how stablecoins can operate within the jurisdiction of the US, but it's not necessarily that they're licensed by the central bank itself. It's just operating under a framework. Here you have licensure by the central bank, which is quite interesting. I think in doing that, right, you provide some level of assurance to the folks that are interacting with your stablecoin that it's operating properly and it has the right governance and oversight mechanisms, right? And I think as you think about any stablecoin or any kind of fiat on chain, the reason people are thinking about tokenized deposits is that is issued directly by a bank who is licensed by central banks or by state authorities. I think as you think about a stablecoin, the idea that it's licensed directly by a central bank or at least by the regulators itself or directly becomes more and more important in terms of providing assurance and trust that you can utilize that asset and that hopefully you can redeem that asset when you need to in physical fiat, right? And that becomes just an important part of this whole operating structure.
And do you expect that regulators stablecoins like AED-backed assets will complete with or complement with other stablecoins like USDT or USDC?
Look, I think it's going to be complementary. I think, the value of each stablecoin is direct to kind of the jurisdiction in which it operates, right? I think every central bank is concerned around, proliferating dollar currencies within their country, right? I think that is not something that can be overstated, right? I think if you look at the model here, you have, a stablecoin that operates locally, but it can also operate globally in terms of dirham-backed stablecoin. And then you have the idea that it can interact with a USD paired stablecoin, right? In the use cases where relevant. And that mirrors what we see in fiat today, right? You have local currency and the local currency can be used to pay on a multinational basis, but also you can do FX into dollars to make transactions or into Brazilian real to make transactions or into euro to make transactions. So we're seeing kind of broader market structure that we see exists in traditional finance just move over to digital rails, right?
Okay, and from Fireblocks perspective, how quickly is institutional stablecoin adoption accelerating in this area? And which sectors are moving fastest? Banks, fintechs, corporates, or asset managers?
It's clearly been the fintech and payments segment that has accelerated the fastest, right? There was the most value to be gained there, right? If you look at what Stripe has done with their acquisition of Bridge, I think almost every payments provider globally that we're seeing today, they're operating or looking at operating with stablecoins, fintechs as well, right? So, I mean, that's been the quicker acceleration, right? Because in essence, those guys are concerned about moving money globally and changing the transactional model that they have today that leverages banks constantly for cross-border transactions. And they see a lot of value in that, right? And so they're just moving fundamentally much more quickly. Look at Western Union, look at MoneyGram. Again, all moving quickly. And we see that at Fireblocks within our payments companies that we have as clients. I think what you're starting to see, though, is this idea or concern around things like corporate and transactional banking, which are some of the biggest lines of business for a lot of banks globally, right? The idea that folks might start utilizing stablecoins and bypass their banks for cross-border transactions, I think becomes a growing concern. And so we are starting to see banks think about what they should do around tokenized deposits or around stablecoin acceptance, right? Either issuing their own or interacting with stablecoins to help really accelerate or complement the products that they have on the corporate and transactional banking side of the house, right? And so that's been a bigger area of focus for us as well at Fireblocks. We're seeing most of our banks start to step into that. And again, a good example of this is like the Quavalis stablecoin consortium. I think it starts with 12 banks as members and growing. You're seeing folks, banks start to interact with things like USDC. You're seeing USDT launch their regulated or US version of Tether USDT in the United States. All of this is being done to really, help accelerate or at least help accelerate the adoption of things like stablecoins within the US and globally as a whole, right? So, this is an exciting growing area of business for us.
What are the biggest remaining barriers preventing institutions from fully embracing stablecoin-based settlement rails?
Generally, the biggest barrier has always been around regulation, right? And I think that's changing. That's not as much of an issue anymore. I think the second piece is for banks are understanding and mitigating risk, right? So they're thinking through what are the right stablecoins to be used, who are they regulated by, what's their reserve basis, how do you think about on-chain risk, like in the protocols, right? The layer ones that these tokens are sitting on, right? I heard a bank once say, hey, listen, we have to think about not only who is interacting with the stablecoin, but who's paying gas fees or where do the gas fees go to? And are they going to sanction regimes, for example? These are things that banks think about, right? A majority of banks today, like if you think about the personnel within a bank, a majority of the bank personnel does not get paid by making money. They get paid by mitigating risk and all the risk that is associated with that, because it can impact their broader business portfolio, right? So, if they're fined or if there's a lapse in risk protocol. So there's a lot of concern around that that they're still working through. And then third piece is really around the right infrastructure, right? So banks have legacy infrastructure, legacy core banking infrastructure. Think about the digital transformation sector within the bank, 15, 20 years ago, and how much time that took, let alone thinking about bringing wallets on chain, open layer one support, thinking about on-chain risk, thinking about basically all the protections that need to go into place to interact with wallets, right? This is a very much a changing dynamic for them, right? And so they're still thinking through the critical, architecture to be able to support this, and in the absence of having that architecture or, infrastructure in place, they can't really adopt it with any scale, right? And so what we're seeing right now is a lot of banking institutions start to issue RFPs or issue some consulting guidance on what's the right kind of infrastructure to interact with digital assets, and then make that decision to then be able to kind of step into the different use cases that we're seeing emerge.
Just final question for you. Looking ahead 2 or 3 years, what role do you see regulated stablecoins playing in global treasury and payment infrastructure?
Look, I think it highly depends on how much those stablecoins can get adopted in the existing infrastructure. And what I mean by existing is, today, if you're a corporate treasurer for a multinational or a Fortune 500, you yourself are interacting with your treasury balances, your payments via ERP systems, right? So if ERP systems are not adopting stablecoins, right, that becomes a hindrance to you adopting a stablecoin unless your bank adopts a stablecoin, right? For example. Secondly, right, the wallet infrastructure, right? If you don't have the right wallet infrastructure in place, you're not able to scale, right? So while the potential of stablecoins we think is very significant, we think there has to be some changes at the underlying infrastructural level to really allow that scale to be able to happen, right? And part of what we do is we work with, different groups, whether they're industry groups or ourselves directly interacting with, some of these infrastructure providers to help them think through the plans of getting that in place. But I think if that happens, I think you really start to see the acceleration and adoption of stablecoins, especially regulated ones, because of all the assurance that they provide, and really enabling folks to access and utilize this for cross-border trade and settlement, right? And I think that's really exciting. There's a lot of benefits to be able to moving money. There's a lot of benefits in being able to move money quickly, right? Both from yield generation perspectives, mitigation of fees, capital allocation and optimization, right? And I think people see those benefits, right, a lot. And so, I think when we do have the right infrastructure in place, we'll see that scaling factor happen by a lot.
Perfect. Thank you very much, Stephen, for your great insights. Friends of CCN, this was Stephen Richardson, Chief Strategy Officer and head of backend at Fireblocks. And again, thank you very much for your time.
Thanks again.